Welcome to the Kaiser Report. I'm Max Kaiser. Disintermediation, baby. Indeed, as Sid Vicious once said, undermine their pompous authority, reject their moral standards, make anarchy and disorder your trademarks. Cause as much chaos and disruption as possible, but don't let them take you alive. Perhaps he was talking about disintermediation. Seriously? He could have been. Maybe. It's possible. Sid Vicious is a prophet. Stacey?
Yes. Well, of course, you've been talking to Reggie Middleton about Bitcoin and the blockchain and disintermediation, getting rid of the banks. So I wanted to show an example of disintermediation, which is quite remarkable and vivid and quite in your face, kind of like Sid Vicious with a safety pin through his nose. So the tweet is from Griffin Carpenter of the New Economics Foundation. And he says, just came across this amazing graphic from 2007. Sardine prices before and after mobile phones. So this is in Kerala, southern India. So here you see the prices of sardines. See the wild fluctuations up and down, up and down, up and down? That was before the introduction of the cell phone. Right here in this region of Kerala, the cell phone arrived then. And then as you see, there's less and less volatility, smoother and smoother price. Same region 2, region 3. So every time once the cell phone was introduced and the fishermen could see the prices and they could have data and knowledge, because free markets are supposed to be about knowledge, but in our present day, they actually don't want you to have knowledge, whether it's hiding all of the true state of the economy through derivatives. For you, the customer, never knows a true state of how much you should be asking for in your credit default swap or the interest rates or anything like that.
Yeah, this is a true price discovery. So the price of sardines here are being accurately broadcast to the market as a whole. And so everybody is getting a better price. The sellers and the buyers are getting a price commensurate with the actual supply and demand at that moment. And those who are gouging are eliminated from the market. And this is the kind of thing we'd love to see, for example, in the gold market. But we're unfortunately deprived of seeing this kind of accurate price discovery in the gold market because the gold bullion banks and the central banks would prefer to see this kind of chaotic non-price discovery, and they artificially suppress the price of gold in the markets using financial contracts. This has been now proven many times over again because they're afraid that if the world went onto a pure price discovery model, the people who are causing the chaos would be put out of business. And
but you also, gold is one thing, but it actually relates to the fact of interest rates, for example. So here you have extreme volatility. Now, if you look at the Bank of England interest rate chart, and their interest rate chart goes back almost 400 years, you could see what interest rates were for the past 400 years here. And pretty much for the first 300 years, while we had tally sticks and gold standards, it was like this, because everybody knew what the true state, what you were getting, what the value was, because everybody knew the value of gold. Everybody knew the value of a tally stick. So that was what we used to have. Now, since we went off the gold standard, so from the 1930s, it gets more volatile, and now since 1971, we have even more volatility, straight like that. So we're going backwards in our global financial system. We've gone the opposite. We used to be like that when true price discovery was happening. Now we're like that, when some middlemen have all the information and everybody else has none.
well, you're making a profound point there.
Thank you.
In that interest rates, the price of money itself, are reflective of a pre-price discovery model, and it shows more chaos. And so, therefore, we're in a crisis of having $200 trillion of debt around the world that was accumulated by the manipulation of the system to reflect interest rates that were not reflective of supply and demand and anywhere near as accurately as the sardine market here in India. If it was, we would not be in the precipitously dangerous quagmire that we are now, and we would not have had the rise of ISIS and other terrorist groups, which are directly related.
So let's turn to the World Bank, because this is also a story that relates to Davos, which is now happening in Switzerland or about to happen. And the World Bank tweeted, global remittances to exceed $601 billion this year, with developing countries receiving over $440 billion. Now, in 2011, at the Davos Forum, Bill Gates spoke, and he mentioned this global remittances market, and he noted that the average cost of a remittance is 10% of whatever was being, so that's 60 billion per year to Western Union and the likes. So here with the blockchain and with Bitcoin, and the likes of BitPesa, we're seeing the global remittance market here, instead of having these, the middlemen who caused this, meeting up in Davos and trying to say, let's be benign, because you know what? Bill Gates was saying, is that 10%? Let's try to get it to 5%. Let's be kind, benevolent middlemen. And instead, here we introduce the blockchain like that to global remittances, and the price crashes.
Well, you make another very profound point.
I'm so profound. I'm like as Sid Vicious.
Which is basically that the introduction of Bitcoin and blockchain would crush the cost of remittances down to virtually zero. This would, again, create massive efficiencies, and it would put money into the pockets of people in a way that's very satisfactory to them, and they would not be then recruited by terrorist groups because when they see that their money is being stolen. That's the first point. The second point is that Bill Gates is somebody that could help blockchain technologies and Bitcoin enter the mainstream in a huge way to help those who are in the remittance businesses and on the receiving end of remittances. But he is a copyright and patent troll. Microsoft, twice convicted predatory monopolist. He is in bed with Monsanto, which is a predatory monopolist. And he's a very bad actor in all of this. And he's benefited tremendously from the corrupt system. So his point should be that, you know what, I'm an idiot. Remittance cost should be zero, and I've been ripping you off for 20, 25 years, and I'm going to retire. That would be a great news from Bill Gates.
The World Bank goes on to say they actually do mention on a blog that they link to that blockchain and Bitcoin will basically destroy the remittances business, those who are the existing ones. And they mention the high street pay-in networks will disappear. They say the biggest single cost of a remittance is the high street pay-in network. The overhead and commissions for these stores and agents, plus the cash management and security expenses, are huge. So that disappears. That's called disintermediation. That will disappear.
Right. If David Cameron was serious about addressing the inequalities in the world, he would facilitate this. But he's not serious in that respect because, of course, allowing Bitcoin and blockchain to thrive would also be a tacit approval of encryption, because it's all based on encryption. And if he were, and Theresa May, who's the Home Secretary, who's trying to fight encryption and fight privacy, even though it means more terrorist activity, by definition, mathematically, 2 + 2 = 4. You fight encryption, you increase terrorism, Theresa May. Do you get it? No, because you're in the pocket of the financial terrorists. Thanks, Theresa. Really great idea.
So let's talk about gold again and disintermediation and reintermediation, because what a lot of war tries to do is reintermediate and put in a middleman into your economy, whether it's here's the U.S. invasion of Iraq. See, it was normal before then, and then it becomes volatile. Same with Libya, same with Syria. Extreme volatility in those economies and societies once...
That's another excellent point.
Yes, thank you. And here, Libyan oil, gold, and Gaddafi. The strange email Sidney Blumenthal sent Hillary Clinton in 2011. So 2 weeks after France began bombing Libya in March 2011, Hillary Clinton's old friend and advisor Sidney Blumenthal passed her an intelligence memo that supposedly revealed France's true and quite unflattering motivations for toppling Libyan dictator Muammar Qaddafi. While France's then president Nicolas Sarkozy publicly said he wished to free the Libyan people from tyranny, Blumenthal's memo argues that he was driven by a cocktail of less lofty incentives, including a desire for Libyan oil and a fear that Gaddafi secretly planned to use his vast supply of gold to displace France's primacy in the region. So I didn't realize this, but France actually had basically France controlled a special currency in the region, which I didn't know about, which is the French worried that the move would undercut the currency guaranteed by the French treasury, known as CFA franc. That's widely used in West Africa and acts as a strong link between France and many of its former African colonies. So when I had heard about this gold story, and this has been around, and the article notes that many conspiracy theorists have noted this, but I didn't know, none of those conspiracy theory sites had mentioned that France actually has a currency in West Africa that Gaddafi wanted to displace. I didn't know that this even existed, that it was backed by the French treasury.
Oh, that is fascinating. And in light of the Charlie Hebdo attacks and the recent attacks in Paris, the fact that the French government could have mitigated the risk of these attacks by simply allowing the markets to work efficiently. This is news. This is interesting. So they have their hand in these attacks. They have blood on their hands. Thank you very much. And Muammar Qaddafi, of course, was in many ways going to free the continent of Africa from the tyranny of central banking by bringing back a gold-backed currency.
Well, everybody's motives, as I said, is always about reintermediation and becoming the middleman. Gaddafi probably wanted to be the middleman for Africa. Who knows? But because he's not allowed to talk about it.
But at the very minimum, he could have introduced some competition.
Yeah.
But when you have rentiers like France and colonial powers like France, you end up destroying all the competition, and you have blowback as a result of that.
So Libya was the #1 for Africa in terms of the World Bank's Human Development Index. They were the #1 country in Africa in terms of free healthcare, free education, the quality of the infrastructure for the Libyan people. Now, what was Sidney Blumenthal? He was there on the ground in Libya when he was sending these emails to Hillary Clinton, who was then Secretary of State. All her emails have been released. Now, what was he doing on the ground? Well, these briefs were prepared by Blumenthal's business partner and former CIA operative Tyler Drumheller, a consultant with plans to pursue government contracts in a post-war Libya. Both Drumheller and Blumenthal worked with a Libyan company called Osprey, a startup that hoped to profit off medical and military contracts in a post-Gaddafi Libya. So, these rentiers often are the swarms of non-combatants behind the soldiers, but they are combatants. It's an economic war. It's a reintermediation war. They don't want that. They want that. That is what a lot of these people want. They want no price discovery.
Yeah, well, we see what happens when you choke off price discovery. You get all these crazy attacks. All right, Stacey, thanks.
I'm going to go get some sardines. I hear they're really cheap right now.
Oh, they're well priced. Well, stay tuned for the second half. A whole lot more. Welcome back to the Kaiser Report. I'm Max Kaiser. Time now to go to New York City and speak with Reggie Middleton. Reggie Middleton's got a new report out called Pathogenic Finance, the Autonomous, Anti-Fragile, Trustless Paradigm Shift Transforming Banking, Brokerage, Securities, and Insurance. Reggie Middleton, welcome back to the Kaiser Report.
Thank you very much. It's good to be back.
All right, Reggie Middleton, one phrase in there that caught my eye was pathogenic finance and viral financial transactions. Talk a little bit about this idea.
Well, the idea came from the biological world. I just think in terms of a viral video, a video that is popular, it's seen by one person, that person emails it, tweets it, texts it to 2 or 3 others, they text it to 2 or 3 others, and it grows like a virus. The term pathogenic finance takes that meme and that idea and brings it to financial transactions. Through the Bitcoin blockchain technology, you're able to make very, very low friction financial transactions. When you go to buy a stock, you call a broker, you go visit a broker, you fill out an application. Sometimes they run a check, they do AML, anti-money laundering, know your customer, etc. You have to put assets in. It takes 2 to 3 days to up to a week to get the assets in, to get approved to trade, etc. It could take anywhere from 24 hours to a month to get your assets in. With the blockchain technology, you could do the same thing in a matter of minutes. Open up an account and do a trade in a matter of minutes. Maximum time, 40 minutes. Okay, minimum time, literally seconds. This low friction, low barrier to entry ability to transact financially, and these are advanced transactions, such as buying and selling exposure to stocks and bonds, etc., or just sending money. You have this reduction in the friction and the barrier to entry, combined with the ease of use, allows actual financial transactions to go viral, just like a video. So you have a video of Gangnam Style that can have 1 billion views because someone tweeted it. You can also tweet exposure to going long Max Kaiser. And someone could take the other side within seconds or minutes, and that can go viral and pass on and on and on, etc.
Reggie, we've seen a problem these past years with market manipulation, price rigging, LIBOR scandal, Forex scandal, gold and silver price scandal. I take it that, all the using this simultaneous consensus-based blockchain technology would eliminate all of that fraud, yes?
Well, it eliminates all fraud that stems from the fact that you cannot see what's going on the other side, and/or it eliminates, actually not all, and it eliminates any fraud that has to do with not paying. Because with the consensus-based blockchain technology, everything that runs through the blockchain can be tracked and seen. You can use it on a pseudonymous basis. Okay, so you don't necessarily have to give your identity, but once you put the assets up, everybody can see that the assets are there, number one. Number two, the assets have to be paid. And number three, you can't lie about it. So the vast majority of the scams and scandals from the last 10 years just are impossible. This should be a regulator's dream. It should be any entity's dream that wants to do business and rely on the fact that the business will be done as contracted. You enter into a smart contract. Once it's executed, it's a done deal, and the entities couldn't break it even if they desired to.
Right. Well, this seems to me as though the entire infrastructure of the banking and brokerage industry and the insurance industry is about to go the way of the dinosaur, in that you don't need any of those intermediaries. So we're talking about millions of jobs being eliminated. We're also talking about the Bloomberg terminal, which is also basically it will no longer be used in the way that it's being used now, because nobody would really need to see all that bids and offers on the specialist book, because they could just program the money to do certain trades under certain conditions without having to worry about rogue traders, dark markets, spoofing, front running, high-speed frequency trading, and all the other scams that are developed. And lasers are now pointing into the stock exchange to scam markets. All that disappears when you have this highly efficient, near zero cost transactions being conducted through the blockchain, correct?
Well, it's a short phrase to the banking industry. It's evolve or die. They don't necessarily have to die, but if you do not evolve, the world is not going to wait for you. See, the banking industry is unique in many of the other very large, powerful industries. They are heavily regulated, but that regulation does serve to protect the oligarchical powers in the banking industry. There's been one banking license issued since before the crisis, and that happened to have been to a Bitcoin technology company, actually, itBit. And it takes a lot of capital and a lot of regulatory pull and a lot of lobbying power to succeed in the banking industry. When you can conduct financial transactions without going through that route, then you have, like you said, a massive sea chain in the banking business model. This is an opportunity for some banks to shoot significantly ahead of their competitors, but it is also a chance for many banks to simply die. And hence, very simple term, evolve or die. And I'm not saying this as an anti-bank person. I want all bankers to die. It's definitely not the case. I'm a capitalist and I want everybody to make money, but the money has to be deserved. I'm against economic rent seeking, with rent seeking being defined as extracting money from a transaction without giving value back in. Think about the guy who stands in front of a door of a burning restaurant and he charges everybody to get out simply because he happens to own that 1 foot strip of property going outside. He's extracting rents from entities or from people trying to get out the burning house, restaurant, without adding value. Now, when people knock him over and they can run out for free, then the rent seeking is removed. That is what the Bitcoin technology is capable and likely to do as we see it.
Now, Reggie, it seems as though the emergence of Bitcoin and blockchain technology is happening at the exact moment in history that confidence in the central banking system around the world, the Federal Reserve Bank in Washington, D.C., under Janet Yellen currently, the confidence is falling rapidly, and their ability to do whatever it is they say that they're due is falling rapidly. I would imagine that the whole central bank model, as we see it today, is also in the crosshairs of this disruptive technology of Bitcoin and blockchain. Your thoughts?
Well, it definitely is. It's not so much in the crosshairs. It's a model that was destined for failure. It simply doesn't work long term. In addition, number one, I think that most of the large modern central banks are going to lose control over their interest rates within the next 2 years. Janet Yellen and the Fed, or the Fed, shall I say, decided to have a token 25 basis point raise. About a year ago, I didn't say a significant raise would happen. After that token 25 basis point raise, which is nothing in the scheme of things, going down from almost double digits down to negative. It looks like they may be forced, they're definitely going to skip the next raise or make a modest raise. They may be forced to go back down and even go negative again. Rates will, the central banks will lose control of rates. But independent of that, they may lose control of currency if the adoption of cryptocurrency happens en masse. And I think the most likely impetus to that would be a state that does something that is not wise, such as the Russian state trying to ban cryptocurrencies, or the Chinese state trying to implement capital controls that they can't enforce. Both of these are likely. The Chinese state has already experienced that with their stock market, and you'll see the Russian state, I'm sure, will be getting very close to it if they don't actually do it.
This is, I think, going to be the topic du jour, definitely, for 2016. I want to pick your brain on another broader subject here. Speaking of dinosaurs and legacy industries, the Saudi Aramco, they're talking about going public, which would be a multi-trillion-dollar initial public offering. What are your thoughts on this, Reggie Middleton? The royal exit plan? Can the markets even absorb this multi-trillion-dollar IPO if it were to go forward? What are your thoughts on this development, Reggie Middleton?
Well, the markets, EX, the lemmings or the Muppets, can absorb it at the top of a bubble. But I tell, I have 3 kids, or one of them was a young man. I tell them, when I teach them about investing in finance, that whenever you have somebody who's an expert or knowledgeable in their field and they're selling, you should never buy. Okay? So the Saudis apparently feel that it is time to sell their crown jewel, Aramco, at a time where oil prices look like they're on a cyclical low, but it's quite possible that the Saudis think that oil prices are on a structural low, that the entire industry is changing. And if they do feel that way, I'm in agreement with them. Selling an entity so large, we're talking multiple Apples. Apple is the largest capitalized company in the world, public company, and Aramco is multiple Apples, several Apples. For them to sell even a fraction of that company should be the writing on the wall to anybody that there's a macro sea chain and there's a structural change. If they succeed in selling, they get to cash out a significant part of a very, very illiquid asset, and more power to them. And I wouldn't be shocked if they take some of that capital and run it straight into the cryptocurrency industry and renewable fuels and energy, which I think they should do, because that would help hedge their bearish bet by selling part of the company on oil and the fossil fuels.
Reggie, you mentioned that timing is very important in these types of decisions, and it seems as though the window to sell Aramco may have been 2 or 3 years ago when it was open, but given the market's current levels and the sell-off and the distribution that's going on, it seems like that window has closed. We have about a minute left or so. Looking out toward 2016 now, what are your thoughts on markets going forward? Is the stock market, the S&P, it's now had a 7-year, 8-year run, pretty spectacular run. Are we at the last, the legs of that run, Reggie Middleton?
Well, fundamentally, we've passed the legs of that run a while back. The market has been forced upward by zero and negative interest rates. The central banks have literally forced institutional capital and even personal capital into risky assets, because they either gave you 0 to no return on the assets, or they forced a negative return on the assets. So basically, they put a gun to the head of those who needed a return or cash flow. The problem is, how long how long can you spit in the face of fundamentals? I think that the risky equity markets are probably some of the riskiest potential investments you could possibly be in right now. You know, there is a chance you can make money, but the downside is significant and outstrips it. And what's unique is that the natural alternative to the equity markets, which be the bond markets, are also some of the riskiest, because the bond markets have elevated and spiked at the same time that the equity markets have, despite the fact you have significant bond risk everywhere. In the junk bond, in the high yield, extremely risky, Alpha's top of the bubble. In the municipals, you have extremely risky. You think of Detroit, look at Puerto Rico, Brazil.
All right, Reggie, thanks so much for being on the Kaiser Report. We got to go. We're out of time. Thank you for being on the show.
Okay, you're very welcome. Always good to be back.
All right, well, that's going to do it for this edition of the Kaiser Report with me, Max Kaiser, and Stacey Herbert. I'd like to thank our guest, Reggie Middleton. If you'd like to get in touch, tweet us at Kaiser Report. Until next time, bye, y'all.